I'm your host, Alden Phinney. I'm the VP of Business Development for a front of the meter business here in North America. And I'm so excited to be sharing our inaugural episode with Thomas Gilles, commercial manager at Gore Street Capital. Thomas has a lot of experience across North American as well as global energy storage markets. Gore Street itself has 1.27 gigawatts across 6 grid systems. And we're really excited to dig into Thomas's experience as well as some of the projects we've worked on together and general trends in the battery energy storage space and energy markets generally. So Thomas, welcome to the podcast. Thanks so much for being here. Wanted to see if you want to give a brief intro to yourself, to Gore Street Capital, and also tell us how you got into the battery energy storage space.
Of course. Thank you, Alden. So Gore Street Capital is the manager of the Gore Street Energy Storage Fund. The Gore Street Energy Storage Fund is the first pure play battery listed fund on the London Stock Exchange, which was listed in 2018, where we currently operate across 5 grids. So that would be the UK, Ireland, Texas, California, and Germany. And we recently, as of last year, announced a fund in Japan, where we are working with the Tochi, looking to build sites within the area of Tokyo. So I started working for Gore Street about 3.5 years ago. I joined the company straight out of university, actually, following an internship with the team, initially as an analyst. And then nowadays I work within the commercial team at Gore Street, which is the team that handles effectively all things related to our revenue contracts. So we worked with GridBeyond, for example, as we've now named GridBeyond as the optimizer of our Californian projects, Big Rock.
Awesome. And we're so excited to work with you on Big Rock and bring it live in the next couple of days, I believe. So exciting times in the California energy market. And I really want to talk with you, Thomas, for this episode around market design and sort of markets globally. Gore Street obviously has presence in very differentiated markets that all have strong underlying fundamentals, I would say, for battery energy storage, but for different reasons, I guess. And so maybe one thing to cover first is around sort of market design and sort of grid stability. I have my own views on this, but I'm curious, how do you think about battery storage adding value to deregulated energy markets generally? Like, where do you see them play globally and maybe in specific markets that you've worked in?
Yeah, I think it's a question that has, a different answer probably for every year we've operated batteries in the system. So initially in the United Kingdom, batteries were, I think, like most new markets, fairly hard to integrate into the system. We participated mostly in fast frequency response services. And that stack of revenues actually probably shows the picture of how batteries are getting used and what gap they're filling within the marketplace, with nowadays batteries playing a much larger role in trading, for example, and helping peak shifting in California, where we import during periods of low solar and export during periods of high load at the end of the day. So I'd say batteries are playing a fundamental role in decarbonization, really plugging in that gap of intermittency that is being left behind by aging gas and coal fleets, for example, but also the increased amount of renewables. But also the batteries can play a much larger role just generally in providing reliability to the grid. And I know we're going to tackle questions around Spain, for example, and what we've seen in that marketplace. And so batteries have a very large array of services that can be delivered. And I think right now we are tapping into part of the potential, but there is also a lot more potential to come further down the line. And so it's a very interesting question, especially in the next 2, 3, 5 years time, of how batteries are actually going to be used in each marketplace and what role they're going to be playing.
And, I'm much more familiar with the North American context, where we see maybe ERCOT as sort of an islanded grid from their own market design, if not physically. I know that, in the UK where you're based, there is truly an islanded grid with some limited interconnections to, continental Europe as well as Ireland. How do you think about, I guess, constraints and what role those play and how batteries add value to the grid? Are you seeing batteries used as sort of like a transmission asset in these island grids? Or do you think that, they're more providing those grid-wide stability services, such as the fast frequency response that you mentioned?
Yeah, I think it's definitely an evolving picture. So most batteries, especially in markets like the United Kingdom, where initially batteries became one of the big markets where they became big. I think Texas as well, especially with sub 10 megawatt batteries in Texas because of the faster interconnection process as a result. That initially batteries were playing these smaller roles, really looking to deliver, I guess, grid services in the form of frequency services, in the form of wholesale trading. But that is evolving, and we're now seeing as projects become bigger and bigger, and the complexity around these projects increases because we are better equipped to deal with them because EPC suppliers understand these challenges better. We're starting to see an evolution where more projects are transmission connected, and that opens a whole new stack to the services they're able to deliver, but also to the, I guess, risk of operation that exists with them, especially when we're looking at nodal risk in Texas, for example, or curtailment risk in other marketplaces. I think it's really interesting. The question of how do we look at constraints really depends on the marketplace where we're operating. The UK has I guess what we could call a very interesting debate going on at the moment with REMA, which effectively we expect a decision on REMA, I guess, either sometimes this quarter, but probably closer to the end of the summer. But on REMA, that is going to define entirely how the electricity market is going to be rebuilt, essentially, and how pricing is going to function with, for those who aren't familiar with it, essentially a difference between either staying with a national pricing United Kingdom or shifting to more of a zonal pricing model. And the REMA seeks to answer a critical problem, which is how do you deal with a high concentration of generation assets in the north and the larger portion of your load going on in the south. And there is going to be potentially flux in the market, which is going to create quite a bit of instability as a result of REMA. But it does send a very strong signal in terms of locational advantages or connection advantages for different systems, which is, I guess, the first challenge. And it's something we're familiar with in ERCOT. In ERCOT, we operate under a nodal model, and the nodal pricing mechanism that operates between our different sites. 3 of our sites are located about a 2 hours drive from one another, and the price differences we can see between all of them is significant because they're either on the correct side of a constraint, which essentially means that they have a significant advantage compared to the rest of the assets. But more widely, all of them are Western Hub located assets. And as Western Hub located assets, they have a significant price premium and spread premium actually to the larger ERCOT market. So these constraints and how do we deal with them was very much a question of what the market design is and how we're going to be building assets to answer a specific challenge that has been defined by the market, because there is either an advantage to us doing this purely from a monetary perspective, or because there's going to be an advantage from a connections perspective or a potential subsidy perspective.
Yeah. No, that's great. And maybe we dig into the ERCOT market a little bit more. I know that's a market where, both GridBeyond and Gore Street have a lot of interest, and it's obviously a very exciting place for battery energy storage. Recent figures I saw were that 80% of the batteries going in the U.S. were either in ERCOT or in CAISO, and so Texas or California there. With that, those are 2 very different markets. Obviously, Gore Street plays in both of them. We're seeing a lot of changes in the ERCOT market, and maybe we talk about that first. Significantly, I think, as you mentioned, the nodal pricing construct of ERCOT is creating differentiation, say, between assets that can be, in Texas, 2 hours drive is, just down the street. But there are huge differences in the pricing that you're seeing between the different areas of the ERCOT grid, either zonally, mentioned the West Hub versus, Houston, but also, even on just different sides of a constraint that can be, miles apart. I guess, how are you thinking about like nodal pricing in ERCOT? How does that sort of nodal pricing in the wholesale day ahead and real time markets compare to ancillary services in terms of the strategy and trading that you're doing in ERCOT?
So tackling the question on nodal markets and how we approach nodal markets, I think when I've been to Texas and spoken to a lot of developers, there is a definite intention to try and maximize nodal outcomes across different systems that are being developed. But I think fundamentally it's pretty complicated to do, if not impossible, because the nodal signal exists more or less temporarily because it seeks to attract investment in that local area and essentially rebalance the market. So I've heard a lot of, obviously West Texas has had an advantage for the last, I don't know how long, but since we've been operating at least for the last 3 years in that marketplace. But I heard a lot of mentions of, for example, the northern hub and advantages coming out of solar in that area, for example, and that creating deeper spreads, or large increases in load coming in around the Permian Basin as well, and how that is going to create a huge advantage. I know there are conversations in ERCOT currently, or at least in Texas currently, about redeveloping the infrastructure connecting to the Permian Basin, allowing for higher voltage cabling, which should alleviate transmission constraints. So the question is, how long does that advantage really exist? And so I don't think you can optimize your battery location as such to target the specific pinpoint advantages, but they exist, and when you can harness them, that is very positive. What that really changes is how you're going to be operating different sites that have different locational advantages or different nodal advantages. And that fundamentally comes, as I said, 3 sites that we have that are within 2 hours from one another. All of them are going to have slightly different strategy approaches as a result of those constraints that exist in their specific area. A site that has a definite nodal premium compared to the others, for example, will be held back significantly more from ancillary services, or will be bid at a higher opportunity cost, which essentially means that more often than not in the market, it will be priced out of the market, and that essentially allows the system to participate more in ancillaries, in wholesale trading, and therefore capture that advantage. So that's really where you're going to see that difference in operational philosophy. I really think, as I said, from a development perspective, it's an interesting effort, and it's definitely something that is, if someone can solve that problem, it is very interesting, but I'm not convinced that it's one that can be solved over the long term. And I think a lot of analysis that was done shows that nodal premiums decrease over time and typically don't exist in perpetuity. And so it really ends up just changing your here and now day-to-day strategy parameters.
So you mentioned the dynamics between the opportunity cost of participating in wholesale versus ancillary services. I mean, this is a dynamic we've been tracking in ERCOT over the past several years. What we've seen is, back in 2022, you were getting 95% plus of your revenue on average for battery storage systems from those ancillary services. Whereas now you're over or less than 50%, right? So a decrease from 95 to under 50% of revenue on average coming from those ancillary services markets, which are RTO wide, and so don't have that nodal basis. I'm wondering how that's affecting your thoughts on optimization for the portfolio. Are you seeing similar, shifts in your portfolio from ancillary services strategies into wholesale day ahead and real time strategies?
I'd say this is, it's a pattern we see across most markets, and there is a definite shift in approach, but also that means there's a shift in design or general interest in different markets as a result of essentially the decrease in value of ancillary services. The main reason for that decrease in value ends up being batteries essentially crowding out conventional thermal generation that would have provided these services otherwise, and effectively creating too much competition on the market that the price ends up being suppressed. The main reason for that is batteries in general, or battery operators, are not very good at determining their own short-term cost of opportunity, because a battery can participate in ancillary services at near enough $0 or £0 or whichever currency, and really the opportunity cost is the cost of state of charge and holding that state of charge. The reality is, for a battery, the cost of operating is the cost of its of the investment that's being put into the system. But because we don't see that tangibly on a consistent basis, or we don't have any fuel to burn, as a result, all participants are essentially bidding in near zero within the market, and that means that prices end up decreasing over time. We saw that pattern, for example, in the United Kingdom. Let's say the UK has, Great Britain more so, and there's been a re-increase in pricing recently. That's really attributable to a couple of factors. One being high procurement, and we're going to see gradually high procurement within services, within different services over time, as there are more renewables, and there are less also conventional generators or thermal generators providing legacy services on the grid. That's good. That's one source. That means pricing sees these increases, and the second one is typical slowdown in build outs as a result of these lower opportunities to make money, and therefore essentially just less competition on the grid, and therefore the ability to make more money. So this trend, which we often describe as somewhat cyclical, essentially means that there is always going to be fluctuation year on year within different pricing structures. This in and of itself doesn't make shorter duration sites obsolete, for example, but it does mean that there is a change in the way that we're going to be looking at duration across different systems, and that really is a factor of, for example, the capex of the projects that you're going to be building at any point in time. And there's a reason we're now seeing the duration, or the average duration, increase year on year of projects, and very much as a factor of that extra duration becoming cheaper, and therefore that advantage coming in. Second part of all of that really is that as we are not participating in ancillary services, we're going to be participating in other markets, which primarily means wholesale energy trading, which in a market like Texas would be day ahead or real time. In the United Kingdom, we have multiple auctions and then a continuous market through the day, as well as rebalancing services. And high duration there just enables us to capture more opportunity on a regular basis. But the fundamental point ends up being, what was the initial cost of the project, and was it worthwhile at that point in time to build a longer duration system? So there is a lot of future proofing involved in development, involved in design, and in the, I guess, genesis of projects. But the fundamental point is, at that moment in time, how did we build out the system? And I know it's a very interesting question in terms of how to say future proofing of design, in that, and allowing for systems to be built but also to be augmented further down the line is very much something that is worth considering for every project being built currently.
And I think the duration piece is really interesting across different global markets. Maybe start with ERCOT, right? So we used to see 1 hour batteries as the standard in ERCOT. Now it's sort of become 2 hour batteries. That's still much shorter duration than CAISO or PJM, for instance, where 4 hour durations are sort of the norm currently. And places like CAISO have long duration energy storage procurements as well. In the UK market, are you seeing 4 hour duration still be the sort of sweet spot for managing capex alongside the energy market opportunities, or do you think the durations are going to go, longer or shorter from here?
So I'd say whatever answer I give today will be irrelevant tomorrow, but we've definitely seen now systems in the UK starting to come in at longer and longer duration. So it's all a question of, again, of what value could we get for a project, or for the build out of a project at any given point in time. The UK actually is going through right now a tender for long duration energy, which for the LDES tender being run by Ofgem, and that is pushing for 8 hour systems on the grid, with projects at a minimum size of 100 megawatts for the current tender process. And so that really shows the, I guess, magnitude of future ambition around batteries. But there is a reason that there is a tender being run here, is because 8 hour systems in general still need financial support to be able to be built, because the standalone business case does not exist currently for these systems. We either don't see large enough troughs of renewable energy generation, for example, generation, which we need to fill, and there isn't enough value in supplementary services on the grid currently to be able to support this business case. So I'm thinking services such as reactive power, services such as black start capability. And the net result of that is, whilst duration is increasing, there is a sweet spot currently in the markets in the UK, which would fit around, I'd say, 2 hours. And I'd say that sweet spot is similar in Texas, for example, around 2 hour systems. California fits completely outside of that realm, obviously, because of its particular challenges, the challenges of large solar ramping and the duck curve in California, but also just in general the RA, which ends up setting the tone for most project build outs and most project designs.
And I think PJM similarly, right? The capacity market encourages you to do 4-hour durations to get a certain levels of accreditation. You mentioned RA sort of creating a 4-hour price signal in CAISO. Similarly, PJM, the capacity market, is sort of leading storage systems generally land around 4 hours for the front of the meter assets going online, at least. I'm curious for these 8-hour long duration, maybe long duration procurements that are being contemplated in CAISO and the UK. Do you think those are going to be fulfilled by just 8 hours of lithium storage, or do you think that there's another technology that's able to play in that space?
Well, it's a very good question. I mean, Gore Street fundamentally is technology agnostic. So we work with lithium because it is the best technology at the moment in time for the services that we deliver. In terms of long duration energy, we still think lithium should be quite competitive and is still quite competitive from a pricing perspective. But obviously, the tenders going on in the United Kingdom at the moment are open to a lot of other technology types, and we know there is a specific look at hydropower, for example, at the moment, be able to deliver pumped hydro specifically to be able to deliver this. In terms of other forms of storage, with flow batteries, for example, definitely a growing technology field that is going to be quite competitive within this marketplace in coming years. But it doesn't make lithium ion irrelevant at all, actually, currently, and we still need to see these projects develop in terms of the capex of all these projects, and also prove their technology readiness. There is, as I said, long duration energy is definitely required. I think there is no doubt about it. What is the ultimate or the optimal way to deliver this today versus 5 years down the line or 10 years down the line? I think it's a changing picture on a systematic basis. So we'll have to see where that goes. But on lithium, no, I still think lithium has very much its place here and very much a role to play within the long duration energy system.
One of the things that we're thinking about with duration and how different duration batteries suit different needs of the grid in relation to the ERCOT market specifically is just around price volatility. I mean, price volatility, I think, is a feature rather than a bug of the ERCOT market in a lot of ways. There's no capacity market. The high levels of pricing that you get during extreme weather or other times of sort of shortage on the grid are really the driving price signal, I think, for a lot of energy generation and storage assets in the ERCOT market. And so one of the things that we're seeing is that the duration of these price spikes can be sort of ephemeral at times, right? They may reflect the fact that gas startup costs have not been met yet. But how do you think about sort of forecasting for those volatility events, both long term when you're thinking about the business case for units in Texas, as well as short term when you're thinking about how do you actually optimize around those sort of price volatility events?
Yeah, so I think our first 2 years of operation in Texas, summer of 2022 and 2023, we saw probably the best revenue or some of the highest revenue we could have seen in those periods, and that was driven by very hot summers, very constrained grids. I'm happy to be corrected if I'm wrong, but I'm pretty sure there was talk of rolling blackouts the first summer we were operating in the marketplace. And ERCOT has come leaps and bounds, and I think Winter Storm Uri definitely plays a role in the preparedness of the grid to be able to deliver against very constrained periods. So its ability to build out more back-end capacity to be able to answer these challenges. And the historic view on ERCOT very much was there are 3 weeks, 4 weeks in the year where we're going to make 80% of our revenue. And that was fantastic when our sites are available, they're able to deliver over time. Obviously, as the grid prepares more, that view is going to change, and we end up with potentially smaller periods of significantly higher revenue, but also a much fatter tail, and therefore more revenue being made throughout the rest of the year. And we saw this coming into this year, where every year we hit obviously record levels of solar, record levels of wind, which when we have periods of very low wind and a solar ramp to contend with, that boosts revenue quite significantly over those periods, and it really creates a very high case for trading in that marketplace. But also, it's just in general, the stack has evolved in that market, where now we make more money from trading, less money from ancillary services, and it disperses our revenue more evenly, let's say, throughout the year. So it remains critical to be able to capture those periods of very high revenue. There's absolutely no doubt about it, because when they do arise, they are often extremely lucrative. And so we can't obviously pretend that it's not an important part of the delivery of services in Texas. But there are fewer of them, and the rest of the year ends up carrying more value generally as a result. So ERCOT is definitely an interesting market in terms of the build out of both solar and wind, whereas we see markets like GB really have a very high level of wind, or California, which has a very high level of solar and creates these specific issues. Texas has an interesting balance going on between both of these forms of renewables. And it means that the optimization ends up being radically different between these different marketplaces, where the ability to capture periods of volatility ends up being defined not only by the solar, but also by the wind simultaneously. And that means better forecasting for renewables ends up being quite important in the short term, but in the long term, build out of these systems becomes relevant, but also decommissioning of thermal plants ends up being quite a large driver as well. Behind the revenue stack. Now, policy direction in Texas is not necessarily unpredictable, but not always favorable. But one thing has remained certain is that there is a, let's say that there is a definite market driving force behind the build out of renewables, and that means that we remain fairly confident in the continued growth of that marketplace in terms of renewables. The second part is Texas load projections are very high, and if accomplished, will drive a whole new challenge also for the marketplace, which is currently there is a surplus of renewables potentially, but in the future there may just be a surplus of load, and that recreates another issue with balancing as well, and the potential for an even larger ramp moving forward. So yeah, a lot of challenges that are very specific to Texas that we have to contend with that don't apply in other marketplaces. But that means that both from a short-term forecasting and long-term forecasting perspective, there is still a potential for very high volatility in the future, especially when it comes to trading there.
And likewise, we're bullish on the prospects of load growth and the volatility that introduces to the Texas market long term, even if the load growth projections are not entirely accomplished, which may be a little bit optimistic from what we've seen to date. But we will see. I mean, Texas has continued to surprise us over the years.
Yeah, indeed.
So you mentioned a few things that I wanted to dig into further. Winter Storm Uri, obviously a huge event in the ERCOT market and in Texas, generally. Just recently in Spain, we saw a nearly nationwide blackout, with regard to grid instability and sort of the challenges there. I guess when you think about the grid of the future, increased renewable penetration, how do grid operators need to continue to adapt to make sure that they can provide the stability that we've come to rely on in these grids? I mean, I'm thinking specifically around inertia, right? If we're decommissioning thermal generation units that have traditionally provided the inertia on the system, do you think that the markets that you operate in are well positioned for the ancillary services stack that they have to prevent the sort of blackout that we saw in Spain just this spring?
There is definitely a lag, I'd say, in the decision making versus what the current fleet of batteries is potentially willing to deliver or able to deliver. And I referred to it earlier in terms of that evolving position that batteries end up playing in that. Nowadays, the technology being built out allows for, or more often than not, sites are able to deliver reactive power, for example, or would be able to provide synthetic inertia onto the grid with very minimal capex implications. And so the net result of that is that batteries are very well placed to deliver these services. Now, most of the network operators have not allowed batteries to deliver this and are still trying to test it out. I'd say a very interesting thing is that the UK is a fairly mature market, which it has been trialing these sort of services with batteries, and is slowly but surely allowing batteries to deliver these products. But every single market should be following that lead. And I think we saw this, with, for example, Spain, where in Spain, the blackout that we saw, whilst there is still a lot of finger pointing and no exact certainty around the root cause, I think one thing we can definitely say is that there was an issue with planning and the ability to create that backup power for either frequency response or for synthetic inertia or for reactive power to be able to essentially create a robust grid. And fundamental element of what we do in battery storage is that we help keep the lights on when there are when there are renewables or when renewables go down. And batteries can do so much more than they're currently being asked to do within all of these marketplaces. So I'd say system operators are definitely looking at this. I won't be telling them anything new by saying this, but I think there is a very large interest from battery storage to be able to deliver this. And the technology now is there, it's proven. And so we essentially need an opening up of these markets for batteries to be able to deliver these services, not only competitively, but probably also cheaper than they're currently being delivered by thermal plants.
Great. No, I really appreciate the context there. You mentioned a lot of these different market constructs. Do you have a favorite sort of market construct of the RTOs that you've worked in?
I'm always going to be favourable to the United Kingdom, because that's obviously where I'm based and where Gore Street is based as well. So we have a preference for that marketplace, and I think there is a lot of interesting things going on within that market in terms of the maturity of the battery space over here, and effectively the fact that we have more or less battery specific ancillary services, for example, and an increasing stack of services where we currently are able to deliver, I believe it'd be upwards of 6 or 7 different ancillary services any point in time, which we can also stack on top, which creates a very big challenge for optimization in the UK. However, I don't have a preferred market. My preferred market are markets where we're able to operate batteries and we're able essentially to deliver services to the grid and have a open and frank conversation with system operators about the role that batteries can play.
Great answer. Yeah, I think that'll make a great LinkedIn short right there.
I'm joking, but no, it's a genuinely interesting point, right? In terms of which system is best prepared to accept batteries, and I don't think any of them, are. The best one is the future markets, right? Poland is super interesting in terms of all of this, and all of them have the right incentives or trying to. So they're my favorite markets.
Yeah, definitely. So you are obviously active in many markets around the world, entering new markets such as Japan currently. How do you think about evaluating new markets for your battery storage assets? Are there specific criteria that you look for in terms of regulatory certainty, in terms of sort of revenue certainty? How do those all play together in evaluating where Gore Street goes next?
I'd say the primary one being regulatory certainty is extremely important. There needs to be an appetite for batteries. There needs to be a need for batteries within those marketplaces. There's no real better way to send a signal that batteries are needed than to opening batteries to the different marketplaces that exist, or to wholesale trading, or to ancillary services, and creating a sort of unencumbered market for these systems. So that really will be the main requirements. The second one is going to be ambitions within those marketplaces. Systems that have very aggressive renewable energy targets are obviously preferred for batteries, because batteries have a definite role to be played there. And then more globally, we as GSF, our approach has been to be looking at essentially the European portfolio with a mandate in Ireland, obviously, where we're looking to deliver, but in these countries where we think there is a fairly reliable approach to these strategies, or there will be a large commitment to building out these renewables, to building out these services for batteries. Obviously, the US being a somewhat of an exception, given the fact that we have these different local regulations, and then all of these marketplaces operate differently. But there is a specific reason we're in Texas and California, and very much was that they were markets in which batteries were widely accepted, could be operated fairly easily, and could be integrated. We know that other marketplaces in the US, for example, have continued challenges and will grow in terms of batteries in the coming years significantly more. But ERCOT and CAISO remain the primary ones. We see challenges obviously in different marketplaces across the world. I'm thinking especially in European markets where now conversations around batteries are increasing significantly. There are challenges that exist. We look at Spain, for example, with the lack of opening or the fact that batteries cannot participate freely in primary frequency response or FCR. That also removes a portion of the stack of revenues for these batteries, which ends up hurting the investment case and the business case for them. So assessment really is going to be a larger approach of identifying markets that are of interest in the first place, markets that are of interest because they have the correct regulatory landscape. And then we break it down by projected revenues, what the revenue stack is looking like, and also with our internal views of, is this going to be a market where we believe we can enter fairly evenly? We've seen markets where there is a definite appetite for batteries and a service, there are services that batteries can deliver, and there is necessary revenue stack, but there are issues regarding connections, for example, onto the grid. And so it's a very large due diligence process every single time to be able to ensure that we are identifying markets correctly, we can enter easily, we can enter quickly, and then we can start operating these systems unencumbered. So it's an increasing marketplace where there are more and more markets that allow this. But I think at the end of the day, most countries in the world are going to have to open up and going to have to accept a certain amount of flexible energy to their systems. So it's more a question of time for most marketplaces.
And we talked a lot about sort of markets and evaluating markets. We worked together last year on an evaluation process for optimizers and forecasting, which is sort of the critical base layer of any good optimizer strategy. And I think that was key to, making the decision to work with GridBeyond on the CAISO asset, Big Rock. Can you talk a little bit about how you think about your partnership ecosystem and evaluating sort of optimization, forecasting, and asset monitoring technologies?
Yeah, we definitely can. I'd say so. As my role in the commercial team at Gore Street, we very much focus on our optimizers and essentially how we can derive the largest amount of revenue from our partnership with forecasters. With optimizers. And so we've run competitive tenders across all marketplaces where we operate to be able to assess the best partnership that we can find at any given point in time. That approach is going to change from market to market. There is no fixed recipe to be able to deliver to be able to deliver the best partnership. There is also, and it has to be acknowledged, less competition in some marketplaces than others, where we have either large monopolies or large established parties that give potentially a lot of regulatory certainty or certainty in general about integration. But where we have a landscape of multiple parties that are able to deliver services to an equivalent level, the challenge ends up being, how do we determine which one is going to give us the largest amount of revenue effectively and is going to operate best within specific parameters that are set for our site? An approach I really enjoy doing, and it's something that we ran obviously with GridBeyond for California, was running live cost scenarios of our systems, where we set real world parameters for that define our system, thinking especially around state of charge management, around trip efficiency management, availability, and optimizing within the market in real time. And then not only looking at P&L at the end of the period, but also specific events and identifying specific flaws within different systems. The reality is no one can optimize to 100%, but optimizing to a high percentile is a large challenge, and identifying where these issues arise, why they arise, or where there was particular excellence in forecasting for specific events, and then being able to trade on those events usually shows us that we're working with the right parties. The other portion of all of this is obviously just a good understanding of battery technology. Batteries are inherently complicated and require a certain level of expertise to operate on a daily basis, but also to keep within the ideal parameters. Batteries in California, for example, would have challenges around temperature management, for example, and so having that visibility and being able to design strategies around those challenges, for example, is definitely interesting.
Definitely. And I know you work with analytics providers as well to provide some of those, real-time data points. Do you want to talk about sort of asset management and the integration of asset management with optimization at all?
Yeah, so it's something that is definitely growing within the service stack of optimizers. Batteries have a significant amount of data, and I would argue, for the time being at least, the market isn't great at harnessing that data systematically, and we're seeing more and more providers pop up that have the ability to harness specific points to provide specific pieces of analytics on degradation, for example, or optimal utilization or state of charge prediction, for example, of systems. And that is great because that enables us not only to have better confidence in the data we're receiving from our batteries, but also probably to extend them ever so slightly, or to maximize optimization outcomes for these systems. So being able to use that data, as I say, is probably the main challenge that we're facing here, on top of having very good data. And once we're able to, as a marketplace, capture this properly and harness it, then batteries not only will be more reliable on these grids, but also will be better performing in general. And it's something that us as a company have focused on significantly, have looked to integrate into our portfolio. And as you point out, we look to work with parties that understand not only the value of that data, but understand the ways to use that data to the highest, to deliver the highest outcomes for our systems.
Great. And maybe I'll just make a quick pitch here as well. You mentioned that GridBeyond livecast that we did around the Big Rock asset last year. For folks that are listening in today, that's something that we're happy to recreate for your assets and do sort of a livecast or a paper trading trial for assets in CAISO, ERCOT, or other markets that you may be interested in seeing our optimization results on. And I'll stop the pitch there.
Yeah, no, it's a fun exercise always. I think it tells you a lot about, as well, also the marketplace in general. And I think as new participants look to enter new marketplaces, the ability to see live data of how a battery is going to operate informs quite a bit, how we should be either designing these systems, if we're talking ahead of actual design, or once we've designed the system, how it's going to be operating, and therefore what support it's going to require over the asset lifetime.
And as we wrap up here, Thomas, really appreciate all the insights you've shared today, talking about the opportunities as you see them around the world. Maybe one final question, what do you see as the biggest challenge for battery energy storage as an industry right now?
But I think, as I said, and I alluded to multiple times earlier, batteries can play a significantly bigger role in the energy systems than they currently do. And so I think our biggest challenge is to prove that and to democratize these services for batteries across multiple grids. If batteries start being able to deliver these services, I'm thinking again reactive power. I'm thinking black start capabilities, for example, and can prove that they are a reliable form of service, then that helps us essentially build a more robust network over time. So definitely, I think our biggest challenge is to get these services developed and to start delivering them. Obviously, it isn't necessarily a responsibility that falls on asset owners or asset operators necessarily, but it's a shared responsibility across the grid. And I think should be playing a larger role in the revenue stack for batteries. And so very much keen to see that development happen in the coming years.
And we'll look forward to partnering with you on making sure that the markets support the role that batteries can play in the energy transition, which we're definitely excited about as well.
Definitely.
Thomas, thanks so much for your time. Really appreciate talking with you as always, and really appreciate everyone tuning in today to listen. If you're interested in learning more about GridBeyond, our services across multiple markets, go to gridbeyond.com for more information. Thomas, any specific materials on Gore Street Capital that you want to leave listeners with today?
I don't think so, no.
Okay. Awesome. Well, thanks everyone so much for tuning in. Thanks, Thomas, again for your time and expertise as always. And look forward to talking to you again soon and hopefully see some of you on the next podcast episode. Take care.
Okay, thank you.